Welcome to the Standard Deviations podcast, presented by Orion Advisor Solutions and hosted by Dr. Daniel Crosby, Orion's Chief Behavioral Officer and New York Times best-selling author. Each week, Dr. Crosby interviews a fascinating new guest on a range of compelling topics, from literature to psychology to financial wellness. To learn more about Dr. Crosby's behavioral finance work at Orion, visit www.orion.com.
Hello and welcome to the Standard Deviations podcast. I am your host, Dr. Daniel Crosby. I'm joined today by Dr. Tom Howard, founder of AthenaInvest and author of two books, including one of my absolute favorites, but Behavioral Portfolio Management. Tom is at the forefront of applying behavioral science directly to the world of asset management. He is someone I consider a true iconoclast in the industry and an all-around good guy. Dr. Tom, welcome to the show.
Thank you, Daniel.
So we have to start off with sort of your road to Damascus moment. You know, you trained as your doctoral training was as a hardcore efficient markets guy, and yet here you are now, one of the loudest voices for using behavioral finance to exploit market inefficiency. What changed your mind, sir?
Yeah, it was a very interesting journey. As you said, I got my PhD in the mid-'70s when the rationality model was taking over finance and investing. And the rationality model, which was dubbed modern portfolio theory. And my background is I'm a quant, undergraduate engineering. My graduate program was in management science, which is the application of mathematical models to business problems. And then my PhD was in finance, statistics, and economics. So I'm quant through and through. And so as I went to the PhD program, the model, modern portfolio theory, and the three pillars of that are the capital asset pricing model, the efficient markets hypothesis, rational markets, and mean variance optimization. And you go through that and you can, when you work with those particular pieces, you can build mathematical models. I'm very much a mathematical person. And so as you went through that, they assume away all of the emotions of the market. They think people are rational, markets are rational. And if you do that, you can come up with really nice closed form mathematical solutions. So we went through and derived all of that. And that really was kind of an interesting, for me, particularly as a quant, that be able to build that those models that particular way. And so the basic message was, you don't have to worry about those messy markets, Tom. Here's a set of nice, simple equations that explain it. And I thought, wow, this is really cool. And so I then, in the late 70s, went to the University of Denver as a finance faculty member. And I taught using those concepts for some period of time. And but I'm also an empiricist, and really models are only as good as they work in the real world. No matter how elegant they are, how fun they are to derive, if they don't work in the real world, then they're not particularly useful. So I started reading the literature, the empirical literature. And as we left the PhD program, there were a few articles, kind of shots across the bow of modern portfolio theory. Said, hey, this doesn't look like it works very well. So the chart we had when we left the PhD program is figure out what's wrong with the tests they're running and see if you can figure out something that would make this look good. So I've read the academic literature. And back in the 80s, of course, we didn't have the internet. And so I actually had to go to the library, physically go to the library at the University of Denver. And they had a section where they stacked up all of the journals for each department. And a couple times, every 2 months or so, I would go through and pick up the top journals and read through them. And Daniel, it just kept getting worse and worse in terms of empirical evidence. And the one event that really probably finally did me in was Black Monday, October 19th, 1987. Stock market dropped 22%. And we all, as that believed in modern portfolio theory and rational markets, scratch our heads, how in the world could the stock market drop 22%? And that particular day, I happened to be in the library at the University of Denver. One of my students ran up to me and says, Dr. Howard, the stock market has dropped 500 points. And at that point, that was 22% on the Dow. And I looked at him sternly and I said, haven't I taught you better? It can't drop 500 points. And of course, we didn't have the internet. We didn't have smartphones. So I went to a librarian. You can always trust a librarian, you know. I said, what happened to the stock market today? And that person said, it dropped 500 points. And Daniel, I can remember standing in the middle of the library saying, wow, my career is over. Who's going to want to listen to me talk about the markets when it's dropped 500 points? Well, I did recover from my panic, but I continued to read the literature, and it just kept getting worse and worse. In fact, as you might suspect, that particular event was one of the most studied in the history of finance research. And the conclusion out of all those dozens and dozens and dozens of articles is there was no fundamental reason why the stock market dropped that day. And you go, okay. And so finally what got tagged was something called portfolio insurance. And if a few managers pursued it, it was going to work. But if all the managers pursued it, it had a fatal flaw in it. And sure enough, all of these very smart, rational, institutional investors started pursuing portfolio insurance. And during 1987, they drove the stock market way up. And then on Black Monday, they drove it over the cliff. So a classic example of herding. And of course, we had this feeling that these guys are rational and making good decisions. Instead, they formed this giant herd and pushed the market over the edge. So by the end of the 80s, I'd given up on modern portfolio theory. Didn't set well with my colleagues. They'd come into my office and say, quit teaching. I started teaching differently. Quit teaching this way. It was even worse with the students because why are you teaching things differently than everybody else is teaching it? And that kind of bothered me. So why are my colleagues in the profession hanging on to modern portfolio theory? And my son-in-law put me onto a book called The Structure of Scientific Revolutions, which is by Thomas Kuhn. And he read through it. And for me, it was a page turner. I'm sure that title just bores everybody to tears. But for me, it was a page turner. And what he concluded is that scientists themselves and the group, all of science, are human and human institutions. And they're subject to the same emotional kind of cognitive errors that, Daniel, you've done so effectively pointed out. And they don't move quickly. They hang on to theories for a very long time. So here we are 40 plus years later, and we're still hanging on to modern portfolio theory in the industry and in academics. But I moved on, ran the MBA program during the 90s. And then when I came out, I said, gee, I don't have a theory anymore. How am I going to do research? How am I going to teach? And so then I began to read the behavioral finance, behavioral economics, behavioral science literature, to which you've made so many nice contributions. Read Kahneman and Tversky and Thaler and Schiller and many, many others. And I said, okay, here we are. This is my new paradigm. And the basic tenets here that investors, individuals and particular investors are not rational, and the markets are not informationally efficient. Those are the two foundations. So that's where I ended up and began to move forward, set up AthenaInvest in 2005 and began. So the confirmation that I had made the road to Damascus transition is my colleagues kept on saying, Tom, you've gone to the dark side. So that was my transition.
I remember October of 1987. I would have been, 7 or just turned 8, depending on, I can't remember when in October that occurred. But I was out in my front yard playing football with my friends. My dad's a financial advisor. He had not gotten home yet. My neighbor pulled up and he calls me, out of the huddle. My neighbor, the dad next door. And he's like, hey, bud, you really need to be nice to your dad today. He's like, when your dad gets home, your dad's had a very bad day. Like, please be cool when your dad comes home because he's not in the mood. So that's my memory of Black Monday. So you have this road to Damascus moment. You begin the heretical teaching of behavioral finance principles to your college kids. But I think it's one thing to reject efficient market theory in its strongest form. And I think just about everyone now has sort of rejected the strongest form of market efficiency. But it's a very different and a much more difficult thing to capitalize on that consistently and to exploit those weaknesses. So I want to talk about that. In your fantastic book, Behavioral Portfolio Management, you write the following. You say, quote, crowds more often than not dominate market pricing, and it is only by chance that individual security prices fairly reflect underlying value. Now, I think there are a lot of people who would agree with you sort of theoretically and philosophically that far from the price always being right, the price is never right in sort of the strictest, most theoretical sense of that term. But that's very different than finding dislocations that are discernible enough, that are arbitrageable enough to do anything about it. So to talk about that, talk about how we can find market inefficiencies that are exploitable if the price is always wrong or only periodically right.
So one of the really fascinating things that happened when I started looking through the world through the lens of behaviors is lots of opportunities started showing up, investment opportunities. And you ask the question, so how do I know I'm going to be able to make money on those and put a portfolio to over time outperform? And so that was our challenge as we started down this process. Formed our investment management arm in 2008. And my partner put in $100,000 to start it out. We're now managing $500 million. So we made some nice progress over that time. But a couple of things that are important in accomplishing that. Number one, we build everything around what we call behavioral price distortions. And so it turns out, and Daniel, this is one of the more fascinating things. If you build your ideas around behavior, it's much more stable than is the old models of, the rationality model. And you know this well. If individuals do not change their behavior, or rarely change their behavior, and I'm sure you agree with that, Daniel, and crowds don't change their behavior. So if I can find something where crowds are making a particular decision, I then need to find a measurable proxy, an objective proxy. So everything we do is based on hard data. So I don't deal with opinions or what you think about this. All our measures are put your money where your mouth is sort of measures. So we find that and we say, okay, that looks like an interesting one. We then I go through the literature, both professional literature and academic literature, and there's of course hundreds of thousands of articles out there. And as you screen through all of that, you typically find several of them that confirm that works, or it doesn't work, and then we abandon it. So it works. Then we have a large database that we put together. We download. So we're a big data investor versus a fundamental investor. And we download millions of pieces of information every day. So we build up this huge database. My son, Andy, who is a technology whiz, I'm sure he could have fixed our situation here today more easily than I did. But put it together, and now I have access to gigabytes of data, and then I pull in the data that I need to test. And our goal is to test it over as long a time period as we have and as broad as we can to see if it works. And so we go through it, and then I compare my results to if there's results reported in academic literature or professional literature, how my results come up. So we don't do anything that we haven't tested ourselves. And then we develop a methodology. So that point, we say, okay, we've got here a proxy that is measurable and persistent for some sort of behavior in the market. And at that point, we begin to develop our investment methodology. So we have to figure out which instruments we're going to use to trade this one, how frequently we're going to trade it, and so forth. And we work on that back and forth. We're using data, and then we decide, okay, that's what it is. And then at that point, we lock in the methodology. So here's what we're going to trade. These are the instruments we're going to trade. This is how frequently. Here are the signals, the specific signals. And again, they're objective. They're not opinion. They're objective signals. And we make that decision. So that, now we're ready to launch it. The final thing we do is develop our selling criteria. And again, this is all rules-based. Everything is rules-based. And so what we do is we're trying to take advantage or harness the crowd's mistake, but we certainly don't want to fall into the same sort of error as they do. So our selling rules are objective, rules-based sorts of decision, which really makes it kind of interesting, because there's times when our signals say do X and everybody else saying you should do Y. And so we go through the same emotion as everybody does, looking at it, said, well, maybe we should have done Y based on that. But we're very disciplined. So it's X, even if we have this gut feeling that it isn't consistent with what everybody else is saying, we do it. And then we end up having those conversations on a regular basis. The result has been very successful portfolios. Our global tactical portfolio, which is our biggest product, is the number one portfolio in the Morningstar category, and is one of the top overall funds in the market. So we've been successful. We have other portfolios that have done real well as a result. So those are the criteria that we use, and the methodology we use to develop our particular approach.
Tom, a couple of follow-up questions. I had lunch with a friend out in Utah recently who's a VC, and he was basically very blunt with me and said, "Why are you fooling around with public equity markets? Like, why do you concern yourself with public equity markets? Because there's no persistence of return, right? We see in the data that only a small percentage of active managers in public equity markets outperform. And then there's very little persistence among that performance, right? Like the people who did well this year tend maybe not to do, well next year or 3 years hence. If the behavioral dislocations are this vast, if sort of the price is always wrong, why are we so bad at this as an industry? Is it because we're not taking behavior into account fully enough, or is it something else?
There's probably a couple of reasons. One of them is that is the incentive. The incentive for funds, mutual funds, and everything else is to get large. You're paid as percent of AUM. So you follow a strategy to build out AUM. So if you've been successful and attracted funds, then you have this incentive to take these funds. What we find when we look at the best funds, the size is kind of a limit, is $1 billion in active equity. So if you stay small, you can then focus, and we'll talk about this shortly, about your best ideas. But they don't. I mean, so for example, back in the late 90s, Janus was just the absolute star. They did growth funds and so forth, growth stocks. And there were reports that they were getting $1 billion a day showing up on their desks. And so what do? You turn it back and say, we don't want you to put money in? Or do we put it into stocks we don't believe particularly strongly in? So most mutual funds turn themselves into closet indexers. And that destroys their performance record. So once you get a certain size, you turn it into a marketing organization, not a performance organization. The other thing is they're not rules-based. They tend to fall in love with their stocks. So I've not been a fundamental analyst, and maybe you have at one point, Daniel. But when you spend all that time looking at a stock and talking to management and looking at their competitors, you think, boy, this is a great stock. And so when I did my stock analysis, I'd say, everybody can be a hard-nosed buyer. You go through and do the analysis, you say, got it down to one or two stocks. Boy, I really believe in these stocks, and you buy them. And then when they get in your portfolio, there's a change. They become part of the family. You take it personally when they go down. You say, how could you do this to me? I went out and talked to you. I put my money into you. How could you do this? And actually, there's a fair amount of evidence that's exactly what happens. Managers fall in love with their stocks. And so, again, you've got to develop a rules-based selling. So regardless, when it hits that particular rule, bang, you sell it. And so the emotions take over once the stocks are in the portfolio. So those are the couple of reasons why you don't see that persistence.
Yeah, so there are some structural and some incentive-based reasons why folks don't want to do this, because we as an industry have embraced things like tracking error as a form of risk management, which is actually quite a silly form of risk management. You and I both believe that. I think we're on the same page too. I spoke at a CityWire event recently to a group of due diligence folks and sort of talked about the futility of in-person due diligence and how it's sort of a behavioral negative because you fall in love with the people and there's sunk costs at play because you've flown down there, you've had dinner with them, you've spent time, all this stuff. It's not a popular idea, but I do think it's one that works. Let's talk about this best ideas piece here. You're effectively, in your book, you cite research that shows that active managers' top ideas do tend to outperform. So, active management has been criticized like red meat and smoking for the last 20 years, but you're saying, wait a minute, our top ideas actually do beat the benchmark. It's just that there's career risk and other incentives that cause us to sort of over diversify. Have I characterized that right? Talk about the power of best ideas, if you would.
Yeah, that's exactly right. So if you interview, and I'm sure you have active managers, you've been an active manager at some point. When I was in academics, I talked to them and say, how many best ideas do you have? And they say, maybe 10, 15, 20 at the most. And then you look at their portfolio and they're holding 150 stocks and you say, okay, so what about those beyond that 20? He said, well, you kind of have to round out your portfolio and so forth. And the research says that those stocks beyond 20 actually hurt performance because they're not your best ideas. And I keep saying, do I really want your second best idea and third best idea, your 100th best idea? I really don't, because I think, again, all of us have limited abilities. We develop a core competency, we work on it carefully and analyze. And so I really want you to focus on your best ideas. But there's, again, huge pressures. SEC is even pushed on this, it's talking about diversified and undiversified portfolios. And it's institutionalized, as you talked about. So there's this huge incentive and particularly if you've gotten big, if you've been successful for a while and then gotten big, now what you do is you closet index and you just track the portfolio. You track your benchmark. And then you spend a ton of money on marketing. And so that's the particular framework. But the best ideas are there. The research is pretty convincing. These people, stock pickers, are really quite good if they focus on their best ideas.
Yeah, the research I've read from Wes Gray and others shows that about 75%, it may be 73%, but ballpark 3/4 of those who are nominally active managers don't differ meaningfully from their benchmark. Right. So, in the whole sort of active versus passive discussion, a ton of my money is in passive vehicles. But I'm paying a passive fee for it, right? I'm paying passive fees for passive exposure. If you're going to be an active investor, I think go all the way and try and find that sweet spot between diversification and actually capturing the potential upside active management. Of course, that is going to give you a more volatile ride. We'll talk in a minute about how to keep investors sort of in their seats. But Tom, your ideas have been extremely influential in my own thinking. I mean, I've got you on the line here, so it's a good a time as any to thank you for some of the ways in which your thinking contributed to my thinking in books like The Laws of Wealth and The Behavioral Investor. One place where candidly you have not convinced me is around debt. Full disclosure, I grew up in a house where debt was considered a 4-letter word. Like, you didn't talk about debt, right? Like, we didn't go into debt. You didn't take on debt. We ate beans and tuna fish for years when I was a kid, so my dad could sort of maniacally pay off our house. I mean, it was just, debt was this thing that was an all-around evil in the home I grew up in. You have a different take on debt. I think most value investors are looking for low gearing in companies, but you have a different approach to debt, and you are actually looking for companies that have some debt. Talk to us about your ideas about debt and how they factor into making investment decisions.
So debt is one of the things we refer to as an emotional trigger. And it obviously triggers an emotion in you and lots and lots of people. So when you use the word debt or leverage, bang, all of a sudden you've got these emotions packed around it. And so when I saw that, I thought, okay, so this is an emotional issue. Can I build a portfolio around that? Because people run away from that for emotional reasons. Part of that has got that reputation because debt is kind of the last brick that falls when a company goes bankrupt. You go into liquidation, the bankruptcy court says this is how we're going to restructure and so forth. And so people say, oh, it's because you had too much debt. Well, it turns out, of course, that what caused that problem is economic failure. Your company didn't do well, and your company failed. And the last thing that happens is now you can't make your debt payments. And so you get tossed into bankruptcy. And of course, we all want to avoid bankruptcy. So it's in my mind, it's gotten really a bum rap. But sometimes people do take on too much debt. So let me tell you how we look at debt in a couple of different in our portfolios. In our pure portfolio, which I've been managing for about 20 years, and again, it's performed quite well. We look for 3 different opinions about the company. One of them is from management, and this is a management confidence. They pay a dividend. When a company pays a dividend, that's a very strong statement. It's not only a statement about current earnings, but it's a statement about future earnings. And so as a signal, it is very important. And if it's a growing earnings, it's even more dramatic. Very, very strong signal. As you know, if you cut dividends or if you suspend dividends, that has a real negative impact on the stock price. So this is a classic put your money where your mouth is. Management can say all kinds of things. We're going to grow. We're going to do all this. But we look at, are you paying a dividend? And that's one of the strongest signals that you can send to the market for your company. The next one we look at is sell-side analysts. They project earnings for the company, and we look, are they projecting enough earnings to justify the price? That's a forward PE ratio. So again, these people are putting out their estimate of what the earnings are. And so that's what we call analyst confidence. And then the third one is creditor confidence. So if creditors, we like to see companies with very high debt ratios in that situation, because creditors, of course, they don't want to lose their money. They lend you money because they think they're going to get repaid. They're going to get the interest payments back. And so that's a very strong statement by the creditors. So now we got creditor confidence, but it's even stronger than that because the covenants in the debt say that if there's any chance you're not going to be able to make your interest and principal payments, you cannot pay a dividend. So if any time that risk increases of default, then they suspend the dividend. And that we sell that stock immediately. Because now I don't have I've got both the creditors and management saying, we're not so sure about the future. So in that portfolio, we've never held a stock that went bankrupt, but we've held stocks that have done very well. So we think, again, collectively investors run away from debt, and this is a situation where debt makes sense. We also use leverage in our global tactical when we got high enough signal. We also use it in our hedge funds. So we use leverage, but we have careful signals say this is really a good time to use leverage, really a good company to use debt. So that's the way we look at it.
You make an interesting point about any part of the market where people have a knee-jerk reaction, right? I mean, I was upfront about my knee-jerk reaction around debt, and I think it's typical of many people like me, and I think typical of people of a certain generation as well, to just say, debt is bad. But you're making the case that debt can actually be, sort of paradoxically a measure of financial strength, right? Like banks are willing to take a risk on this company because they are credit worthy, and so that can actually be a sign of strength. I want to transition now to talking about diligencing managers. I touched on it briefly before. You mentioned in your book one of the most useful behavioral concepts around. I think I'll spend a minute on it for the listeners because I think it's so pervasive and so powerful. And it's this idea of answering an easier question. So you see this whenever people are confronted with a complicated decision. You think about the decision about who you're going to marry. This is a person you're going to have a romantic life with, a financial life with, potentially you're going to raise kids together. You're going to, make decisions about what color to paint the house. I mean, marriage is this sort of all-encompassing thing. And so if you really wanted to make a good decision about who to marry, it'd be very tough. You'd have to consider a million different facets. And so instead we just go, hey, they're I like the way they look and I like to spend time with them. So let's do it. Right. I'm not sure we examine that with the level of granularity, that this seriousness of marriage warrants. You think about something like voting for president. There's so many facets of that, right? There's so many facets of the work of a president, everything from, foreign policy to domestic policy to, how they'll select a cabinet and, everything in between. And so I think we answer an easier question like, are they a member of my party? Or, would I like to have a beer with this person? Or do they seem amiable because of the enormity of that question? Now, you make the case that when people are diligencing fund managers, they answer an easier question because, again, that's a complicated decision. And so they ask questions like, how much money do you manage, or how long have you been doing this? And you get sort of hilarious things. I was on a site the other day that will remain a secret, but it was like our investment team has 750 years of collective experience. And you're like, what does that even mean? Right. But they're exploiting this tendency for us to want to rely on this easier question of how much money do you make, or how much money do you manage, or how long have you been doing this? You say that's not optimal. If you were to design a behaviorally informed manager due diligence process, what would it look like?
So that's an excellent and interesting question. So we say behavior is predictive of future performance where past performance is not. And so, that's, as you well know, the representativeness bias. If they've done well in the past, they're going to do well in the future. And we see this everywhere, don't we? Baseball or football or any, if you've done well in the past, you're going to do well in the future. And so that's that. In terms of the size issue, well, lots of people have put money into you, so that it must be okay, right? It's kind of a herding sort of thing. And then, of course, the length of time you've been around an extended period of time. So the behavior that we found that really makes a difference is that you pursue a narrowly defined investment strategy. How do you go about making your decision? I'm talking about active equity managers. So how do you go about finding the stocks you want to invest in? And we want a narrowly defined strategy. We want you to focus on 4, 5, 6 things. So for example, I described our pure strategy where I talked about 3. There's a couple of other things. So we have 5 things we focus on. I do not want a generalist. I don't want my value manager talking about the economy. I don't want my economic manager talking about valuation. I want you to focus and be an expert because, as you know, it takes a tremendous amount of effort and a tremendous amount of skill to be able to do these sorts of things. So focus your attention on that one thing. So pursuing and consistently pursuing, and I want you to do the same thing over and over and over again. Just keep doing it, keep doing it. There are times when strategies are out of favor. They all are. The way, of course, as an investor that we get around that is we diversify across strategy. We buy valuation managers and future growth managers, competitive position managers. These are all the kind of strategies we've identified at Athena. So consistently pursuing a narrowly defined strategy. And we actually have objective measures of that, something called strategy-based investing. The second thing is we've already talked about. I want you to only invest in your high conviction positions. So it's consistency and conviction are the two behaviors. And then the final thing is, if you want to ask something, you talk to a manager, how do you decide what to sell? And if you think, well, we kind of look around and think about it. And no, you need to have a rules-based selling decision because, again, the evidence is pretty overwhelming that if you do it that way, and this is not just true of individuals and advisors, but these are professional managers. And there's a study done by Essentia that's looked at a number of big managers, and they fall into the same trap. They fall in love with their stocks and so forth. So those are the behaviors. So and that's what we do when we look at funds. We look at those particular behaviors. We have shown that those are predictive of future performance, and you get away from the other kind of due diligence.
So, Tom, one of the things I've found is that when you try and explain some of this to clients or potential clients, you really just lose people, right? I mean, when you say things like, we're going to own 15 or 20 stocks, so the upside potential is going to be, going to be there, but it accordingly. So will the potential for volatility and for a downside, right? If we're wrong, and when you talk to them about things like automation or a quant strategy, they sort of are like, who's at the helm, and like, shouldn't they be digging through dusty reams of value line research and not just sort of automating this? When you talk about something like debt, which people have a visceral reaction to, you have a very unique approach. And indeed, I mean, I'll even say the sort of behavioral framework that I set forth in some of my books bears a lot in common with what you're talking about today. And it just sort of flies in the face of conventional wisdom, even though it's entirely consistent with what the research says. So when you think about trying to raise money and training clients that will stick with you for the long term, how do you do that? How do you find and select and train clients that can take this sort of unconventional journey with you?
So a couple of things in here. We found that we have a fairly narrow market segment that we go after. The largest segment is what we call the nervous Nelly bulge bracket. And those are the people that have all of these triggers, emotional triggers. And every time, just like you said, every time you say it, they're gone. And that's a huge segment of the market. And there's lots of funds that appeal to that. We'll reduce volatility, we'll reduce drawdown, we'll hold 200 stocks, we'll so forth and so on. And they end up underperforming, but the investors feel comfortable. We have a group that we go after, and that we say have high emotional intelligence. They're willing to put up with short-term volatility, drawdown, the use of leverage, concentrated, high conviction positions. And so it's a relatively small segment. We do a lot of information on our site, AthenaInvest.com. We have lots of material we have there. We put out something pretty much on a monthly basis, something called a behavioral advisor, which is a one-page, deals with a current event from a behavioral standpoint. On the back page, it says, what can you do to improve your emotional intelligence? And those one-pagers, we've got 50 or 60 of them up there that deal with all kinds of issues like that. So we've got to get people used to short-term volatility. If you're building long-term wealth, short-term volatility, we're not talking about your emergency funds. We're not talking about the kind of catastrophic risk that you do with insurance. We're not talking about your short-term income. We're talking about building long-term wealth. So part of the thing is to get our clients to stay with us is we talk about the bucket model, where we say, okay, here's your emergency fund. Yeah, volatility and drawdown is important there. So fund it with money markets and banks, investments. Here's your short-term income needs if you have that. You may even use bonds in that situation. But for the long term, building long-term wealth, 10, 20, 30, 40-year wealth. I used to go to my undergraduates when I'd start my class, and I'd look at them, I'd say, so what's your investment horizon? And they'd kind of look in their air, and I said, how about 60 to 80 years? And they go, whoa, wait a minute. I can't even imagine being 25, let alone 70. But yeah, they have and even I'm 73, and I have probably a 20-year investment horizon between myself and my wife. So we all have long-term, and so that's what we're aimed at. We're aimed at that segment of the portfolio. We try to get people used to the idea of short-term volatility and drawdown, the use of leverage and so forth in the right situations, and build that long-term right. In the case of long-term, the risk is not volatility and drawdown. It's leaving money on the table. And as you know, everybody's looked at this, right, Daniel? If you don't have the highest return investments, you leave, even millions of dollars on the table over the long run. So that's what we're trying to do. So we're trying to improve our clients' emotional intelligence in that regard.
Yeah. It's smart, I think, to do your outreach and your educational efforts. That's, I think, anymore for boutique asset managers, that's a must. You need a tribe of people who are bought into your vision and who are happy to take the ride with you. So, Tom, last question for you. You talked early on, we're sort of circling back here. You talked about how all of your signals are behavioral signals. I've written in my books how it's critical to have a behavioral underpinning to any sort of signal, because it's harder to arbitrage away because behavior tends not to change, right? Sort of these easy to exploit market efficiencies, as soon as they're brought to light, they get arbitraged away. Behavior is, in a very real sense, forever, because people are stubborn and recalcitrant to change. So, but I think there's an open question about what behavioral looks like. Because when I talk to, indexers, they would say, yeah, I'm a behavioral investor because I know I can't predict anything and I know I can't see the future. So I just buy the market and ride it out. When I talk to momentum folks, they couch it in behavioral terms. Value investors are very much cut from a behavioral cloth as well. Chartists would say that they are sort of pure distilled behavior because it's all about price. What does behavioral mean to you? I'm not asking you to give us your secret sauce, of course, but when you say a behavioral signal, what are sort of the constituent parts? And would the true behavioral investors please stand up, Tom Howard?
Well, we've probably gone further out than most, but the truth is, Daniel, that every active manager, whether it's bond or equity, is a behavioral investor, right? they're trying to find behavioral price distortions, and they all go at it differently. So a fundamental analyst will go out and look at the financials, will look at their competitive position of the company, look at their competitors, do all kinds of things. That's the objective thing they use to identify behavioral price distortions. If prices are correct, then we can't earn above average returns. So the technicians use past prices, which I think are pretty difficult to use to make money. We have our own unique behavioral indicators. We're probably, again, a little further out than most. But the truth is, it's all about behavior, right? Markets push the prices away from fundamental value. And how do we identify that? And so the fundamental analysts think, yeah, we're fundamental analysts, and we do all this careful analysis, and we look at things and so forth. But they are behavioral investors. They happen to use fundamental analysis to identify those behavioral mistakes. They also think they're information. I'm Janus. I can beat the American funds analysts, and it becomes a real contest, doesn't it, between them? But that's a really tough game to win. They're in essence, they're all looking at some kind of behavioral price assertion. They just go at it a different way.
Yeah. Well, Tom, you have been an incredible guest. I hope that people will take the opportunity to see you speak live. It is a real treat. Tom is a guy who just loves to put a stick in the eye of convention, and it's really fun to watch live. But Tom, if people have enjoyed your thoughts, they want to read your books or learn more about your firm, where can they head?
Yeah, it's AthenaInvest.com. We have all our resources up there. We have for advisors and investors and market. So we have tremendous amount of resources available to learn more about behavioral portfolio management. So yeah, that's the place to go.
Awesome. Tom Howard, thank you so much, sir.
Thank you, Daniel. I enjoyed it.
Thanks for tuning in to Standard Deviations. If you can't wait till next week for more behavioral finance insights, visit www.orion.com. All opinions expressed by Dr. Daniel Crosby and podcast guests are solely their own opinions and do not reflect the opinion of or endorsement by Orion and its affiliates, subsidiaries, and employees. This podcast is for informational purposes only and should not be relied upon as a basis for legal, tax, and investment decisions. The opinions are based upon information the participants consider reliable.